We're here today to launch our November bi-monthly report, our last bi-monthly report for 2015, in what has been an exceptionally busy year for the commercial real estate market, both from an investor and indeed an occupier viewpoint. A combination of continued deleveraging from NAMA and the various banks, coupled with a huge amount of secondary trading going on off-market, has seen huge transaction volumes in all sectors of the market. And indeed, at the end of the third quarter of the year, in many sectors, annual transaction volumes had actually been exceeded. As domestic economic conditions improved over the course of the year, the attractiveness of commercial real estate improved, and we saw a huge amount of international and indeed domestic investors availing of the opportunity to invest in the Irish commercial real estate market. The focus for the next 2 months of 2015 will be to get transactions across the line before year end and bring what has been an exceptionally busy year to a close. In the investment sector of the market in recent days, we've seen the MSCI index being released, showing that a total return of over 6% was achieved in the third quarter of this year, with an annualised growth rate of over 28% being achieved to the end of September. This is a very strong volume of performance, albeit the volume of activity and returns has eased somewhat quarter on quarter. Investment spend for this year is likely to come in at about €3 billion, which again is a very strong result, but it needs to be taken in context of the many loan sales which occurred over the course of the year, which are counted separately. Demand for multi-family residential opportunities has been somewhat thinner of late, primarily as a result of the uncertainty that's currently prevailing with regard to government plans on the housing sector and any proposed intervention that may happen in that space. Demand for lot sizes of less than 20 million has also been a little bit thinner of late, with much of the demand from both domestic and international investors focused on some of the larger portfolios that are being offered for sale at the moment, including an office and residential portfolio at Elm Park, which is guiding 185 million, the Whitewater Shopping Centre in Kildare, which is guiding 150 million, and One Spencer Dock, which is the headquarters of PwC in Ireland, which is currently on the market guiding 240 million. One thing we have noticed in recent months is a greater pricing differential being experienced between prime and secondary investment assets, which has really only started to emerge in recent months. We've also seen very strong levels of activity in the office market over recent times. Indeed, at the end of the third quarter, we'd already exceeded annual average volumes of take-up in the market, so we're certainly on course to beat last year's volume of take-up by year-end. The supply of existing buildings continues to decline, and indeed the average rate of vacancy has fallen into single digits for the first time in more than 15 years. This has resulted in an increasing number of occupiers signing pre-lettings in some of the buildings that are currently under construction or in various stages of the planning process. We certainly have seen a lot of development news in recent times, with several large planning applications having been granted planning. According to our research, there's currently demand for over 250,000 square metres of office space in the city, with most of these requirements small to medium size as opposed to some of the large requirements we saw in 2015. An increasing proportion of occupiers are now willing to locate outside of the traditional CBD, primarily because rents are cheaper, but also because there's an availability of stock in these locations. Some of the occupiers that are in the market at the moment include Slack, Pivotal and SAS Business Analytics, looking for space in Dublin. Prime rents at the moment are about €52.50 per square foot, but are certainly on target to reach our forecast of €55 per square foot by year end. We've seen continued activity in the retail sector over recent times. Indeed, new figures out this week suggest that retail sales volumes increased by over 8.5% year on year, with improvement being seen across all sectors of the retail sector, which is very encouraging. A very busy Christmas trading period is now in prospect, helped by some degree by the cuts to the universal social charge in the most recent budget, which will boost personal disposable income and in turn hopefully boost retail sales activity over the Christmas period. We would expect to see further upward pressure on rental values on both Henry Street and Grafton Street over the course of the coming months due to some recent transactional activity. We would also expect to see the rental growth that's now firmly becoming established in this sector filtering down to more provincial locations over the course of 2016. The main focus for retailers over the course of the next 2 months, however, will be capitalising on what is likely to be one of the best Christmas trading periods they've had in a number of years. In the industrial sector of the market, we had bumper take-up of over 310,000 square metres in the first 9 months of the year. There are a number of transactions to cross the line before year-end, albeit not of the magnitude of some of the large sales and lettings we saw happening earlier in the year. This sector is slowly moving into the development phase of the cycle, with a number of planning permissions having been lodged over recent months, albeit only one speculative scheme actually under construction in the market today. Prime rents are about €72.50 per square metre at the moment and are on target to reach €75 per square metre by year end. We've seen further contraction in industrial yields over recent times, with the prime industrial yield today at about 6.25%. Activity has also continued at pace in recent weeks in the hotel and licence sector of the market. We had seen 54 hotels having traded in the Irish market, totalling 650 million in the first 9 months of the year, and in recent weeks we've seen further transactions, namely the Clarion in Cork, which sold for over 35 million, the Castle Martyr Hotel in Cork, which sold for over 13 million, the 4-star Hibernia Hotel in Kilkenny, which sold for over 7.25 million. So lots of very large transactions still occurring in this sector, and indeed further sales when you count loan sales. We're seeing appetite from domestic and international buyers, and they're very much encouraged by the domestic economic backdrop and also an improvement in hotel performance figures over recent times. We're also seeing an increase in the amount of refurbishment, extensions and improvement programmes happening in the hotel sector, and in the Dublin market at least we're beginning to see the first signs of development starting to occur. Following what has been a bumper year for the Irish tourism sector and indeed the hotel sector as a result, hoteliers are now gearing up for what's looking likely to be a very busy Christmas trading period, helped to some degree by the retention of the 9% VAT rate in the most recent budget. We've also seen 25 pub properties changing hands in the Dublin market so far this year, which is quite encouraging. In the development land sector, there's been a lot of discussion over recent weeks about the lack of inclusion of housing measures in the most recent budget. Only 2,500 new homes were developed in Dublin in the first 9 months of this year, and less than 9,000 were built in the country as a whole, which is significantly below what the market needs. So the lack of detail in last month's budget was most disappointing. There has been continued activity in the development land sector, however, over the course of the last couple of months. We saw strong volumes of activity in the first 9 months, and it's likely that the last quarter of the year will see a similar volume of trades to last year, albeit many of the transactions are still relatively small in size. One of the outcomes of the central bank mortgage affordability rules, which came into effect earlier this year, is that there's now increased demand and increased appetite for lands outside of the CBD in the commuter belt. We are urging landowners and those that control land within various loan books, etc., and portfolios to bring more land to the market over the course of the coming months. This is needed to facilitate the development that we need to happen to address the severe housing shortages currently prevailing in the economy. All in all, a busy 2 months are now in prospect as we try to get transactions across the line before year end and bring what has been an exceptionally busy year to a close.